Hello and welcome to Inside Out, a show where we will focus on individual stocks with in-depth analysis, deep dive into the financials, and tell you about the key risks and triggers going forward. Hi, Nigel.
Well, hi, Sonal. Well, we'll also put the spotlight not only on the key matrix that Sonal just mentioned, but we'll also ask questions that you want to ask. So let's not waste any time and let's get straight to the first stock. Well, Sonal, tell us, what do you have on deep dive for us?
Okay, Nigel, imagine you're buying something for Navneet on an app. And suddenly, the advertisement of an tech company, it pops up suddenly.
Okay.
And you're like, okay, let me actually try and get it for my son. You actually subscribe to it and so on. And you take it forward basically. So the company which is responsible for that ad on your cell phone while you're surfing on the internet is actually Affle India. It is an advertising tech platform and provides end-to-end mobile advertising platform. So in simple terms, they tie up with various online platforms to show their ads on users' device by using companies' artificial intelligence algorithm. They do not make or design ads, but they use artificial intelligence to throw their clients' ads on users' web page. So they have two business segments here. Consumer platform, which is basically all of the revenues, and enterprise platform that contributes around 1% to their overall revenues. They have higher revenues coming in from the export markets at 64.5%, and the rest actually is coming in from the Indian markets.
Well, Sonal, so they're doing well in both markets. But what about their financials? What about their balance sheet as well? And normally we observe, well, in these tech-related companies, they have good amount of cash in their books. Is that the case for Affle India as well?
It is, but let's talk about their revenues first. Revenue growth has been good, aided by acquisitions that the company has made. So in 9 months of FY22, they have done revenues of around 770 crore rupees, which is higher than FY21 revenues. And acquisitions are the reason that companies' margins from levels of 26.5%, they've come down to 22.2%. But in most of the cases, company has been able to turn around their acquisitions. But not all of them were margin accretive. As far as cash is concerned, Nigel, in 9 months of FY22, they had cash of around 500 crores in their books.
Okay, all right. So that's a fair idea of business on the whole then, Sonal. But let's get in the management. Let's call in Mr. Anuj Khanna Sohum, the founder, chairman and CEO of Affle India, to take this conversation forward. Well, good to speak to you, Anuj. Thanks so much for joining in. Well, you have been focusing on emerging markets, and of that, well, India is a big share as well. How do you ensure high margins despite low unit economics? Digital advertising as a percentage of total advertising here in India is only around 25% odd. So the penetration is still low. Where will growth come from?
The advertisers are increasingly shifting most of their budgets towards digital and mobile marketing. As you rightly pointed out, India has about 25% of the total ad spends going towards digital or mobile. And the trend is quite similar across other global emerging markets. Now, what I expect would happen is that the advertisers would necessarily need to spend at least 50% of their total ad spends on mobile and connected devices in the next few years. And we have a very unique business model. You know, we charge the advertiser on a cost per converted user business model, meaning that when the user as a consumer sees an ad on their mobile screen, or when they click on the ad, Affle doesn't charge the advertiser for that. We wait for the consumer to actually convert with the advertiser into the apps or the physical stores of the advertisers. And once that conversion event happens, we are able to charge a ROI-linked pricing model. So therefore, our margins are superior because the advertiser's willingness to pay on a ROI-linked business model is better. And therefore, even with the tough unit economics of emerging markets like India or other global emerging markets, Affle is able to defend its margin and keep a very bottom line sensible and aggressive growth journey for our company.
Okay, so in that case, in the long run, what kind of growth are you looking at for revenues, X of inorganic growth? And also give us an idea on margins then.
In the last quarter itself, we did more revenues than we did in the entire year of FY20. And, that is substantial because you look at how in less than 2 years, we have achieved this kind of scale. And while defending our pricing, the CPC rate, we're doing higher volumes, clearly, but we're able to defend our pricing. If you look at the cash flow from operations, the ratio to PAT, I think that is a very healthy ratio of 100%. And I think that is showing that the quality of revenue and the quality of customers that we have is, clearly exemplary. Now, in terms of the forward outlook, right, where, you're asking, like, can this growth continue to sustain? Now, everything that Affle does is anchored on sustainable, profitable growth. And the fact that we're in a privileged industry where the average industry growth rate is expected to be 25 to 30% CAGR for next 4 to 5 years. And as long as Affle continues its unique business model, differentiated approach with verticalization, vernacular, like the 2 V's of our Affle 2.0 strategy, we believe we should be able to beat that industry average growth rate.
And what about margins? As I said, they have come off their highs. What is the outlook on this one?
Actually, I would like to disagree. The margins haven't really come off the previous highs. What you need to look at the math is that we have been acquisitive. Because we were cash flow positive, because we were generating internally accrued cash flows and a very strong balance sheet in the company with minimal, almost very little debt, we are deploying our cash to create inorganic growth. Now, if you look at the last 3 transactions that we have done, whether it is Jamp or AppNext or MediaSmart, all of these 3 companies were barely breaking even. They had no bottom line contribution when we acquired them. And so when we acquire them and we sort of look at the consolidated numbers, you'd find that, okay, what was earlier 25% margin, now combined basis, there is a business that's contributing single-digit margins. So the average effect comes into play. But what's very interesting is that we are clearly giving guidance that our playbook is each of the acquired companies within the first year of the acquisition would turn to high single-digit profitability. In the second year of the acquisition, it'll go to mid-teens. And by the time it's in third year, it should reach around 20%. And if that were to happen, you would automatically see the averaging up. So it's a mathematical sort of model. It's not that the margins have gone down, but the margins have gone up organically. And then the inorganic contribution averages it down. But then, we're seeing a clear path to bringing it back up.
Got that, Anuj. But Sonal, let's come back to you then. What is the revenue model like? Well, they put out ads on digital platforms, as you just mentioned. But how do they earn money?
Okay, so the company has an interesting policy here. The model is called cost per conversion unit, which basically means how much it costs a web advertiser to acquire real customer. And real customer is the one who actually makes the purchase. This is what they get from their clients. Company gets 90% of the revenues in the consumer platform from CPCU, and the rest is from the non-CPCU model. Now, a table will come up for you, and look at the table. CPCU revenues are basically a function of users which are actually converted and actually who make a purchase, and the CPCU rates, they have actually been increasing over time. So that is something that you'll see here. So higher rates and volumes have led to higher revenues for the company here. So this is about their CPCU rates, but let us understand from the management what is the sustainability of those revenues and rates. Anuj, if we see the CPCU rates, they have seen a sharp increase in 9 months of FY22. What has led to this, and is this sustainable? And is there a difference in export and domestic markets as far as CPCU is concerned?
Sure. It is. If you look at the balance of our business, right now it is over 30% from India and over 65% from international markets. And when we look at that balance and we look at the historical trend, earlier the business used to be almost 50% India and 50% international. And now, because the mix of India versus international has changed, and you're right that the domestic versus international business, the CPCU rate is actually higher. We can charge higher in certain other geographies, and India's unit economics is one of the toughest. So not only are we profitable and growing fast as a market leader in India, but we are also able to see that we are able to replicate that success across other international markets and quite broadly and vastly across all the different verticals that we work in. So the pricing has moved up. The average CPCU that used to be around 40 rupees has now started averaging around 50 rupees. And I think that is a very healthy sign for our business. And that should also be a sustainable sort of balance that we are looking at as we execute further.
Well, Sonal, you as well as Anuj, both of you all highlighted about these better volumes, but as well as realizations. But how much of this is organic? How much of that is inorganic? I want you to break it up for us.
So, lots of acquisitions, Nigel. It is a long list. So, mentioning some of the important ones, just look at it. It started with Vizuri, in 2018. That is followed by Revex. We had MediaSmart, there's AppNext, Bobbleye, Discover Tech, and the recent one, Jamp, which gave the company online presence in Latin America and US Android market. The list is big and it keeps adding on to their revenues overall.
Okay, let's pose a question then to Anuj. Well, Jampp as well as Appnext, they have been the big additions to your portfolio. Are you looking for further inorganic growth? And will this money be returned to the shareholders, maybe in the form of a big dividend, maybe in the form of a buyback? Go ahead, Anuj.
As we go further, our goal would continue to be consistent, that we will deploy our cash, internally accrued cash flows, towards accelerated growth. And that will be both acceleration on organic growth as well as inorganic growth. And inorganic growth means that we will be doing acquisitions as well, or investments which are strategic and they make us strong as an ecosystem level player. Can we give any specific guidance on that? The answer is no. At the moment, there is no plans for dividends because, like I said, we're a fast growing company and I would like to unlock much greater value and use every asset that we have in our balance sheet to drive for growth.
Okay, all right, got that, Anuj. Well, so the company has inorganic plans in place. They also spoke to us about those acquisitions. But Sonal, explain to us some examples. How do they actually change the ad dynamics for their customers? I want to get a sense of that.
Oh, yes. So let me give you and explain it to you via 3 examples.
Okay.
Our first customer, Byju's, which is the education tech company. They used AI-powered algorithms to identify and connect with high-intent users. And in small towns, they targeted regional ads, which showcase popular entertainment and other apps, which actually resulted in 83% increase in monthly conversions. That's about Byju's. Let's move on. About Gcash, which is a leading fintech player from the Philippines. There, they identified users who have higher affinity towards online transactions. And that is what they targeted, and it led to a monthly conversion growth of 47%. The third one, Fetch Rewards, is a leading mobile shopping platform in the US that rewards shoppers for their purchases. There, the company actually identified ad formats to drive the most conversions, and that's how they're actually making revenues, Nigel.
Well, Sonal, but I'm sure this would be a very big industry, right? Very competitive. Along with that, there would be some risk as well. So say that for us.
Oh, yes. Competition, of course, is one of the biggest risks that you just mentioned. And bigger players like Facebook and Google are also in the ad tech industry. Now, there's so much focus on privacy norms, right? So analysts are worried that regulators will actually put it on the internet industry, and it will likely undergo paradigm shift from largely an ad-driven to subscription-driven one. This can actually deflate companies' volumes, and that is the biggest worry that the company has right now. So let us take it forward to Anuj now. Anuj, the big fear is that because of the privacy norms, there will be a shift from ad-driven to subscription model. And analysts say this could hurt your CPCUs and conversions. What are your thoughts? And global ad tech market is very competitive with big giants like Facebook and Google. Is that a threat?
Specifically for Affle, our technology platform has been accredited as per Singapore government's Infocomm Media Authority standards. And that already is a strong indicator that a government or a regulation where there is already Personal Data Protection Act, which precedes even GDPR in Europe. So Singapore is fairly advanced in terms of how it addresses these trends. So as of today, I can tell you that there is no nervousness in my mind and no risk as such with respect to data regulation. And in fact, I could say and stretch it that it is actually a competitive moat for us because we as a company has demonstrated that we can be compliant and we can deliver. And therefore, we think that data regulation will help us to be more credible and execute better. In terms of Google and Facebook or large players in the ecosystem, it is true that a lot of the digital spends have largely gone to Google and Facebook globally. I mean, in every country that you look at on an average, you'd see maybe 65 to 75% of the total digital ad spends going and gravitating into walled gardens of Google and Facebook. Now, is that a bad thing? I think the answer is no. I think we over the last several years, one thesis which is clear is that the non-Google Facebook part of the digital advertising pie is actually growing at least as fast, if not faster, than the Google and Facebook part of the pie. And all of these regulations, if I may say, are clipping the wings of the larger players a lot more than they are. In fact, for players like us, they're empowering us and actually helping our competitive moat. Whereas for Google and Facebook, I think the regulation is going after them a lot more strongly. We can see that in developed markets, and I think we will see that in emerging markets.
Well, good speaking to you, Anuj. Thanks so much for joining in and giving us your thoughts. We look forward to touching base with you rather soon. Well, Sonal, let's wrap this down then. Tell us what do the valuation parameters look like, and also if you could give a sense about their top shareholders.
Okay, so since there is no direct competitor for the company in the listed space in the Indian markets, I'm comparing it with global peers. Not all of them, but some of them. So looks like it is pricing in a much higher growth and is one of the expensive stocks in the advertising technology space. You asked about shareholding as well. Promoters hold around 60% stake. Also some marquee funds holding the stock here. Malabar with almost 4% stake. You also have Aberdeen and the other ones on your screen, Nigel.
Okay, all right. Sonal, thanks a lot for that and explaining all of that to us. Well, that was a deep dive into Affle India, but it's time to slip into that short break.